Careful. Which bond market? I'm talking about the US Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year, from 0 to 1 year, they're called bills. From 2 years to 20 years, they're called notes, and the 30 years called a bond. So if you're an expert, you say bills, notes, and bonds, but they're all treasury securities. I just want to be specific. We're not talking about corporate bonds, just to be clear, because those may do very poorly. If a company is going to underperform, we're going to go into recession. We're going to have to see bankruptcies increase. Those corporate bonds are going to get hammered, but certainly junk. So we're talking about as treasuries. The funny thing now is that the highest yields in the US Treasury market are in like a 6-month bill. Like, wait a second. Shouldn't I get more if I buy a 30-year bond? Or shouldn't I get more if I buy a 10-year note? It's a longer maturity. More stuff can happen. Inflation, credit downgrades to the United States, bank freezes, all those things can happen. I want a higher interest rate for my longer-term security. That's usually the way the yield curve looks. It kind of goes. It's upward sloping. The longer the maturity, the higher the rate. That's not true. Today, the highest maturities are right around 6-month bills, 1-year bills going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield of maturity than you do on a 2-year note. So the interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I say, the best of both worlds, but the highest interest rate is actually from 6 months to 1 year. So those are very safe securities, and they're paying like 5.25%, not quite 5.5%, but between 5.25% and 5.5% for a 6-month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, oh, yeah, Jim, that sounds good. But if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money. But that inverse relationship kind of throws a lot of people. But that's just how it works. So, yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it a year from now, or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going to a slowdown, we're looking at all kinds of geopolitical risk. Stocks are coming down, then interest rates are going to come down too. So again, 10-year note is riskier from a market point of view, not risky from a credit point of view. Good yield and a lot of capital GA. Ins. Today, GDP was up 5%, and that was the number. It was the first government estimate for the third quarter of 2023. It was up 5. But it was very heavy on consumption and very heavy on InBev. So in those two things, well, consumption, obviously, people don't realize when wholesalers and distributors build up inventory, that counts as GDP. It's fine to build up inventory if people are buying stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices. They do 2-for-1 sales. They just move the merchandise. And particularly in certain areas, stuff goes out of style. And the fashion industry is notorious. Who wants last year's coat or whatever? So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. sometime around mid to late August, after 2 pretty strong months, and they were strong. The consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021. What was going on? Starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $600 check. And then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. I mean, we were spending not spending. We were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that. But the deficit alone was about $2 trillion. And no Nancy Pelosi handing out money. Well, Americans got used to that. Thanks for the check. And then there was a deferment on student loans. You didn't have to pay your student loans for about at least 2 years, maybe a little bit longer. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low, like 3%. It was up around 13% during the pandemic. It's about a little over 3%, 3.5% right now, which is low. They spent the savings they had. They didn't make new savings, and then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while. But then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit is used up and the interest rates are 20%. Some of them are 28%. You're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out. Your balance is going up because the interest is compounding faster and you're paying it down at 25%.